In this video, we are going to do an introduction about investing in mutual funds. So what is a mutual fund? Think of it as a portfolio with a variety of stocks in there and different securities at different levels, not necessarily equally distributed. And what you do is you buy a piece of that portfolio. And many people get to do it as well. So almost half of US households invest in mutual funds for 3 reasons. Easy way to invest. Yes, it is an easy way to invest. Those portfolios are typically diversified already for you. They're managed for you. So the firm that is handling the mutual fund will rebalance those portfolios as time goes by automatically, and you don't have to worry about it. Professional management, that's the piece I'm talking about, and diversification. Characteristics. So we have some closed-end funds. These are just different names. Just over 500 investment companies offer closed-end funds. So these are less typical. So what happens is when the fund first opens, the shares are distributed or sold and so on and so forth. Now, after that, you can only buy shares from another investor willing to sell. So it closes. So once the 100% of the shares are sold, it closes out, and they don't issue or sell any more pieces of that portfolio. And then you'll have to buy from another investor if somebody's willing to sell in order to get in there. Then we have ETFs, exchange traded funds. These are newer type of portfolios in the grand scheme of things. They've been around for some time, but they came way after mutual funds were in place. So it's very similar to mutual fund. It's total portfolio, it's managed, it's diversified. Most of them doesn't have to be. One of the biggest differences of mutual funds and exchange traded funds is that you can trade exchange traded funds throughout the day the same way you would trade stocks. Well, mutual funds, you can place an order to buy or sell your piece, but it gets only done at the end of the day. So if you were trying to take advantages of movements in the market, that would not apply. Now, ETF funds generally invest in the stocks or other securities containing a specific index. They typically imitate an index. It doesn't have to be. That's just what you typically see on ETFs. And mutual funds mutual funds may also follow an index, but not necessarily. Now, for the ETFs that do imitate an index, then there's no real active management like they would in a mutual fund that does not follow an index. And it's because it just has to imitate. So whatever index, let's say the S&P 500 index changes, then they just change this ETF. They rebalance the stocks and the shares in it accordingly. So they're just copying something. There are about 1,900 investment companies that offer exchange-traded funds, compared to the 500 of closed-end funds that we spoke about here. So they're more popular, more generally available. And then we have the open-end funds. These are still mutual funds. Notice 9,000 investment companies offer open-end funds. Now, remember, mutual funds have been around longer than ETFs, and ETFs typically only stick with indexes, and mutual funds can be tailored and created and shaped in whichever way the management team wants to do it in order to offer them. And that's why there are a lot more flavors, to put it that way, out there. Now, the big difference of open-end funds and closed-end funds is that it just allows anybody at any given time to buy into the fund without having to buy necessarily from another investor. So all it is just it grows the total amount in the fund. some more vocabulary: load funds and no load funds. Load funds, there's a commission, could be up to 8.5% every time they purchase shares. That is if it's a load fund. Honestly, a lot of these commissions and fees are going away, and it has to do with competition out there, free no charge trading and things like that. However, because some funds that are actively managed and are shaped in a specific way, those you're still going to get those load funds because it they have to control the in and out activity of the fund, or helps control, let's put it that way. No load fund, investor pays no sales charge up front. You deal directly with investment company by internet, telephone, mail, with discount brokers. Similar to the no fee trading that you see a lot now in these days. Contingent deferred sales load, charged upon withdrawal of funds, referred to as a B fund or back-end fund. So this is if you withdraw funds, just like it is, just like it sounds like. If you decide to go ahead and withdraw your funds out of the mutual fund, then there's a fee for getting out. But similar, it's become more and more rare, and only specific mutual funds will have this. And it has to do with the type of mutual fund and the way it's structured and the way it's being managed and the goals of the fund, etc. Management fees, these pretty much apply to everybody. And if you log in any brokerage firm out there and you look at a specific mutual fund or portfolio or ETF, somewhere in there is going to have the fee that you're being charged. And yes, it's very typical, between 0.5 and 2%. 1% is, in my experience, what I see the most popular one, but it really varies depending on the fund. The 12B-1 fees, those are distribution fees. Annual fee to defray distribution and marketing costs and commissions paid to brokers that sell shares in the fund. As of right now, the regulations cannot exceed 0.25% of a fund's assets per year, levied on Class C shares, which have no sales load or contingent deferred sales fee. In other words, if these apply to the ones that don't have these other fees that we mentioned earlier, like contingent deferred sales and other fees like that. Expense ratio. There's another number that you will immediately see in any web page that is presenting a fund to you. What it does is brings in all the management fees, the 12B1 fees of any, additional operating costs for a specific mutual fund, and they do an expense ratio. This is the number that you definitely want to look at, because while management fees may be low, then when you tack on all the operating costs, et cetera, the expense ratio tells you, gives you a more complete picture. This fee should be 1% or less. It should be. There is no rule saying it shouldn't be, but if you see anything above 1%, then you definitely want to have other reasons why you really want to be in that fund. The investment company's prospectus must provide all details relating to management fees, sales fees, 12B1 fees, and other expenses. Yes, the prospectus, but like I said, as soon as you look into any fund online, those numbers will be somewhere on that webpage. Okay, classification of mutual funds. So if it's a stock fund, let's say the mutual fund is, and it doesn't have to be, but in this case, all stocks, all equity. You have the aggressive growth funds, buy stocks in small, fast-growing companies. And we say aggressive, this is the high end of aggressiveness. Now, understand this aggressive growth, these are small companies that are fast-growing. Typically, these are younger companies. So you will see a lot of ups and downs and volatility. So you have to have high risk tolerance to be here, because you may go long periods of time with some serious downturns. And then with your patience and the time that you have to wait, then eventually it would go up. On average, you do really well on your returns, but you have to let the bad times roll, like they say, and just let it ride. Then you have equity income funds. These are stocks that pay dividends pretty regularly and amounts fairly predictable. So people do that when they want to receive dividends. These aggressive growth funds, because these are fast growing companies, and as I mentioned younger, dividends should be non-existent because they're supposed to be holding to their cash in order to continue growing the company. Global stock funds, just what it sounds like. These are international stocks. There are funds out there that may have a combination of these things. There's not one or the other always. Some dedicate specifically to those deals, but some just may have a combination of a blend of all of them. So more on stock funds, you got the growth funds by stocks and company expecting higher than average revenue and earnings growth. So it's a different type of growth in this sense. These will be more like companies that are growing in market share a lot, which will translate in higher earnings, but the value of the companies are going up based on their market share. There's more to it, but that's kind of like a one way to look at it. While here, these are companies that their earnings, their net income is expected to grow a little higher than their industry they're in, a little more than an average. They just may have some good expectations on their sales volume or cost efficiencies. Index funds by stocks that mirror an index. As we mentioned earlier, some funds are just imitating indexes, and that's it. International funds, same as global. Invest in foreign stocks sold in security markets throughout the world, i.e. outside the United States. Let's go back to global stocks funds by stock and companies in the US and other countries. So the key difference is this one includes the United States and international, so it's global. When we say international, it's just international outside. Large cap funds invest in stocks of companies with a total capitalization of 8 billion or more. Now, the $8 billion amount, that's just now, the number we have now. Large cap just means the large companies, the largest ones. Now, a reason I say 8 billion because 50 years ago, 8 billion wasn't the number. It was a much lower number. And it's just regular inflation of dollars. So all you have to think about is that we have large cap, mid cap, and small cap, and just the size of the company compared to each other. And we do have numbers where it cuts off, but those numbers change over time, the dollar amount. As you see here, mid cap currently, you should look at them between 1 and 8 billion, and small cap is anything below that. You got regional funds, buy stock in companies in a specific region of the world, like let's say Asian countries, Middle Eastern countries, African countries. It could be like Europe only. Sector funds, buy stock in companies in a particular industry, such as biotechnology. Now, I want to sector and industry are two different terms. One covers a broader range, but the idea is that they're going to be within a group of type of industries and sectors. Biotechnology, medical, services, manufacturing, things like that could be the way it's identified. Small cap funds containing the whole large, mid, and small, buy stock in lesser known companies with a total capitalization of less than 1 billion. Now, lesser known because they're small, they're probably just starting, they're growing. And I said before, these ranges in dollars, they just change over time. Now we have socially responsible funds. Avoid investing in companies that produce harmful products. Okay, so when it comes to social responsible, we also have other ones that we call moral funds, and it all comes down to a preference on the investor. If an investor says, I don't want to invest in any company that has to do with the oil industry, then you were looking for these social responsible funds that tailor to that. Others may say, like, I don't want to invest in anything that doesn't do sustainable XYZ or anything chemical. Whatever it is your preference, there's more than likely a fund out there where it excludes those specific type of activities and companies that participate in those activities. Now, that said, that is a personal choice. As of right now, things may change in the future. As of right now, because you're excluding certain type of stock and companies, you limit your diversification. You're still going to have a good diversification, but you're limiting, but you're also limiting your potential return. So in order to pursue the investor, in order to pursue their values or behave according to their values, is willing to sacrifice some returns. Sometimes doesn't always work that way in order to promote those. Other ones, we call them the sin stock. It's just a jargon name. Some people don't like to invest in companies that deal with cigarettes, alcohol, certain forms of entertainment, violent stuff, guns, for example, or anything like that, or national defense contractors. In other words, the ones that make tanks and fighter jets. Some people don't want to deal with, let's say, cigarettes, alcohol. Nowadays, with marijuana being more popular in the States and becoming legal, some people don't want to invest in that. So what they do is they say, we want portfolios that do not have these sin, quote unquote, stock in them. But same thing, if you exclude certain industries, it may limit your opportunities of returns. High yield, or junk bonds, as known as a jargon thing, it just means bonds with a high return. But as we know now, in finance, in order to get high returns, you must take higher risk. So these are typically companies that may not be doing too well financially at the moment, and they're considered high risk of default. So in order for them to sell bonds and get people to lend them money, they have to agree to higher payments, higher interest rates. And that's where the high yield comes in. But they say junk because we don't consider them investment grade. They're more on the speculation side because you're taking the higher risk. Intermediate corporate bond funds, buy investment grade corporate debt that matures between 3 and 10 years. Again, intermediate US bonds, but instead of corporate, same time frame, but from the government. But these are from the United States government, the federal ones. Long-term corporate bond funds, over 10 years for corporate bonds, investment grade. So the investment grade are the ones that are less risky, but you'll get a lower return. So they're not these high yield bonds. So more bond funds. We have the long-term US bond funds. So now federal government again, federal bonds greater than 10 years. Municipal bonds, those are the ones that are state level or below. So you have the federal bonds, United States bonds, and then you have state level bonds, county, city, township, you name it. But anything below the federal level, state and below. Now, one of the key reasons to separate those two, the federal government versus the state, is because the ones in the federal government are guaranteed by the United States Treasury that you will get your payment. State and below cannot guarantee it. They're fairly safe, but slightly riskier because cannot be guaranteed. An advantage they offer, the state ones and local ones and township, cities, counties, is that you get a tax break on that interest earned. And it's a way to help the states be able to fund and borrow money by offering a lower interest rate. So it lowers their cost of getting that money. But for the investor, it translates to the same return because they're not going to be paying tax, some with taxes. Short-term corporate bonds, investment grade corporate bond issues, short term, less than 3 years. More bonds. Now we have the short-term US government bonds. Those are federal ones also. They're also guaranteed, less than 3 years maturity. World bond funds, buy bonds and other debt security of foreign companies and governments. Just what it sounds like. You go outside, now you're buying stuff outside that is located outside the United States. Just like the United States sells bonds, the United Kingdom has their bonds and Germany has their bonds, etc. But also companies in other countries have bonds as well, corporate bonds. Other funds, back to the funds itself. Asset allocation is an important term in finance. And this is where the basis of diversification, or where diversification happens. Which all you're doing is invest in various asset classes, such as stocks and bonds, with precise amounts maintained within each type of asset. Meaning that you'll say, okay, I want to have 20% of my money in bonds, 80% on stocks. You can do 20% on bonds, 70% stocks, and 10% in some other type of security or commodity. But the point is that the asset class is different. Balanced funds invest in both stocks and bonds with the primary objective of conserving principal, providing income and long-term growth. This will be like, it's not that it's different from asset allocation, is that the way that you distribute your money across those assets will then follow these objectives. Conserving principal, so you want low volatility, so the actual value doesn't drop below, well, it may drop, it just doesn't drop as too much if it happens from the amount you put in. Providing income, there'll be like dividends, interest payments from bonds, etc. And then long-term growth with a healthy level of growth over time. Now, always remember that these last two are a trade-off. The more income it provides, the slower the growth. It's still going to grow, but it'll be slower. The less income provides, the faster the growth. But that's for planning and your investments, and it's a different discussion. Funds of funds. So you may just have different pieces of your capital, different percentage of your capital in different mutual funds. But then when you look at it as a whole, it's a portfolio built of a variety of portfolios. And that's what say funds of funds. Life cycle funds. This is the typical approach for retirement. If you are in what we call a defined contribution retirement plan, then what you do is, and this is related to asset allocation, what you do is that when you're young, when you're in that part of the life cycle, and this is for your retirement, you have a lot of time before you're going to need to take cash, or a lot of time before you should be taking any cash out of it. Emergencies do happen, but since that's the plan, early, you want to go for a lot of growth, very little income, and you can take, you can go aggressive. You can take risks because it's going to have violent swings up and down, but over time, it's going to grow faster because of that. But then what happens as you get older, you start shifting that aggressiveness into safety. So by the time you retire, you're on the safe side. And that's what it says here. Initially invest in more risk-oriented securities. That's when you're young, and become increasingly conservative and income-oriented, bonds and CDs being safer as a specified retirement date approaches. Money market funds, invest in CDs, government securities, and other safe and highly liquid investments. Now, yes, this is typically a step that you take before you get into retirement. Like, you need to have your emergency fund, and it's okay to have the emergency fund and money market funds, because these are very low return, but they're highly liquid, and they don't really go down. They don't lose value, but at least it's not just sitting there. So this is one of the lowest risk, lowest return, but still better than a savings account. How to decide to buy or sell mutual funds? Well, Managed funds versus index funds. Think a bit of mutual funds versus ETFs, because that's going to be more of the vocabulary you're gonna hear out there. But it doesn't have to be that way. Most mutual funds are managed funds, as we mentioned. So they're actively managed. An index mutual fund is the mirror image of a specific index and has lower expenses. That is true. That is true. So to give an example, if there's a mutual fund that is an index of the S&P 500, and then there's an ETF that is also following the S&P 500, you're probably better off with the ETF because it's not actively managed. It's going to have lower expenses and there's more flexibility to it. Now, if you're looking for a specific type of a portfolio that doesn't follow an index, but is built for certain goals and certain targets, then a mutual fund might be more beneficial or may fit your strategy better. So more on the differences. Majority of managed funds have failed to outperform the S&P 500. This is true. This is very true. And to translate this, as managed funds here, and you see all these words, the key term here is active management. That's what a managed fund is. Active management, because it has higher expenses than the passive managed ones, typically the fund itself may on the surface, some of them look like they perform better than the S&P 500, but after taking out all the commissions and fees and expenses and active management transactions, etc., you're better off on the long term to have just done an index passive management approach. Now, it's important to understand a long period of time, because what happens is at any given time, a managed fund may outperform. But the point is that they cannot consistently do it. So on the long run, it doesn't show. By long run, could be 5-10 years, for example. There's this thing called prospectus. It's not just only for mutual funds; it also happens for stocks, etc., and other securities. But there's some minimum information by law that must be in there. And these are some of the key elements it should include: the objective and fees, that's for sure, risk factors, past performance, type of investments in the fund's portfolio. So you need to know which industries, which sectors, which companies, dividends and capital gains, as in historical, then many times it's expected, but at the minimum, they have to tell you what's the history on this. But that's pretty much similar to past performance, is related to that. The funds management, as in active versus passive, but it may also include the actual names of the managers. The process for investors to buy or sell shares, information on limitations or requirements, if any, the fund must honor when choosing investments. Information about how often the fund investment portfolio changes and tax consequences of a fund trading activities. So being a mutual fund is going to be actively managed. So you want to know, because every time the portfolio changes, there are transaction fees. So they do it fairly often. Now, I'm not saying they do it fairly often just to charge you more fees. It's just it may be a highly active portfolio with a certain objectives in mind, and it requires frequent transactions. But at the same time, you need to know that that's what you're getting into. And there are tax consequences because the trade activities, depending how they do it and how they re-inject capital gains or capital distributions and stuff like that to the investor, is going to affect your tax situation. How to open an account with an investment company is a prospectus. So you're not an investor yet. Then just let you know how you can become an investor. Annual report, detailed financial information, letter from president and independent auditors. This is the minimum. This is the minimum that you see in an annual report. Each company, each stock has an annual report. However, that also can be an annual report of just the mutual fund itself as a whole. Okay. So there's a difference between having an annual report for each individual company of the stocks of the mutual fund versus an annual report of the mutual fund itself, which is a more, it's not going to cover each company. It's going to cover Similar things like the financials of the mutual fund, similar things you see here, but then additional information of the company running the mutual fund and what they intend to do. Return on investment, ROI. So shareholders receive a return in 3 different ways. You can receive it if we talk about stocks here. Income dividends. So if there's any cash dividends, you get it from there, but also interest income. If there are bonds in the portfolio, you also receive interest payments. But also keep in mind always that these things are taxed as regular income. There's no real special tax treatment. They could be, but there will be an individual situation per person on average. No. Capital gain distributions are the payments made from the fund to its shareholders that result from the sale of securities in the fund's portfolio. So what happens is that when they rebalance the portfolio, they're going to sell some shares to buy some other shares somewhere else. Well, when they sell those shares, it could be that they're sold at a higher price than they were purchased. So that creates a capital gain. There could be tax implications, but typically it's a long-term capital gain taxation, which is better than a short-term capital gain taxation. However, tax laws may change at any given time. So that's it at the moment. That's how it works. Now, the one thing to understand is that regardless of how long you own shares in the mutual fund, you do get to enjoy the long-term capital gains versus if you go ahead and purchase stocks yourself and then sell in less than a year. Now, there is some nuance to this because it also depends on how long the shares were in the mutual fund. But that's the typical thing. That should be your expectation. That's one of the benefits of mutual funds. The other form of return investment, capital gains, which is not the same as capital gain distributions. This is when the mutual fund buys and sells shares, and you are entitled to some of those according to how much you own there. Then we got the capital gains occurring when shares are sold at a price greater than you paid. When selling the shares are taxed on a short-term or long-term basis. So think of it this way. This is when the managers of the mutual fund, there's one way to look at it, buy and sell stocks, and they have to give you some of those capital gains based on their decisions. Now, when you buy and sell a piece of your mutual fund or your ETF, you may get a capital gain out of that. On that one, you're subject to short-term or long-term based on how long you owned that piece of the fund. That will be it for this video. See you on the next one.